Hello everyone, welcome to Study Synthesis. Today we'll explore a unique financial system that is rooted in principles of fairness, justice, and risk sharing. So, whether you're a student, professional, or someone who's curious about ethical banking, this is your chance to learn about a rapidly growing global industry. So, Islamic finance, before diving into this whole topic, we can first define what exactly we mean by finance. So, finance is the management, creation, or you can say the study of money and investments. If we see it through conventional setup, so businesses that acquire capital through loans that involves interest, this creates a situation where lenders profit regardless or of outcomes leading to societal imbalances. For instance, I can give you an example. If a borrower takes a loan for a business, they might repay both the principal and the interest. Even if the business fails, this creates an unjust system where the financer grows richer while the borrower grows poorer. So, in Islamic finance, the factor that the richer or the financer grows richer while the borrower grows poorer, it eliminates this injustice through some principle, or you can say like risk sharing or ethical profit generation. But however, this creates injustice in society, we all know that. So if a business fails, the borrower is still obliged to repay both the principal and the interest, regardless of their losses. So this imbalance actually makes the financier richer and the financee grows poorer. So let's look at some basic finance, Islamic finance principle. So here we can say that the Islamic finance takes a different approach. The guiding principle is based on Islam, or you can say the hadiths by uh, Prophet, peace be upon him. So the guiding principle for the hadith would be al kharaju bin bi al daman, which means the entitlement to profit is based on liability or for losses. So in other words, we can say that profits are earned through risk taking. Okay, and other than that, there is also a saying that says risk shared, risk promotes stability and fairness, which means that reward begets risk. So the shared risk promotes stability and fairness. Unlike conventional finance, in conventional financing, the risk is transferred entirely to the borrower. So Islamic finance usually operates through specialized modes of finance, like we can say ijara, murabaha, mudaraba, or salam or istisina. We'll move forward and look all of these in detail later on videos. So let's talk about the next topic, prohibited activities that we have in Islamic finance. So Islamic finance is basically governed by strict prohibitions to ensure ethical transactions, and these includes prohibition of riba, which is also known as interest, where charging extra on loans or debts is forbidden. So which means like if you have lended some money, or if I have got a loan from you, and you told me at the time of the contract that I'm going to return the loan at somewhat time period, and if I'm unable to do that, I'll have to pay extra money to you. So that extra money is known as interest. So in Islamic finance, interest is prohibited totally, and we are not permitted to take interests. So this extra charging of money is known as interest and riba. Next is prohibition or gharar, or you can say uncertainty as well. So transactions must avoid ambiguity and be transparent, which means that the transaction between two people, it should be transparent. The person who's a financer and who's a financee, they both should be aware about the terms and conditions of the contracts, and there should be transparency in everything between them. Then there comes prohibition of kimar and maisar. This is also known as gambling. So the games of chance, you mean, and speculative practices, these are all not allowed in Islam. or Islamic financing. Other than that, the transactions that are haram, which means that financing all the activities that are not allowed in Islam or that are prohibited in Islam, for example, alcohol, pork, these kind of things which are basically haram in Islam. So financing on those activities or transaction about those activities are prohibited. Then comes fraud and deception. Obviously, we know that the honesty is the key to every transaction, and honesty is mandatory. So we need to keep in mind that we have to stay away from doing fraud or doing injustice and being dishonest in these kind of finances. Let's move on. So there is a comparative overview of Islamic finance and conventional financing. See, so we can distinguish between those what is prohibited in which kind of financing. So interest, if we talk about the interest here. So interest is obviously known as riba and it is prohibited in Islamic finance, but in conventional financing it is permitted. The banks and the people, if we consider them in conventional finances, they actually do transactions on the basis of interest. If we see risk sharing, so in Islamic finance, risk sharing is mandatory. Means that financer and financee both have to share the risk in those transactions, in those type of contracts. But in conventional financing, it's optional. If you mostly it's very common if you do transactions with the banks, if you are taking a loan, if you are acquiring an asset on loan, if you are doing anything with the banks, you usually don't get the opportunity to share the risk. They usually transfers all the risk to the financee or the person who gets the money or the borrower, you can say. ठीक. Okay. Other than that, if we see about asset backed financing, I just told you about that. If we get an asset, not money, if we get an asset, so it is required in Islamic finance that you don't finance on money. You don't do the transaction on money or cash. You should do the transaction on the basis of assets, because assets are non-consumable and money is consumable, and transaction on consumable items is prohibited in Islam. While we can see in conventional finance it's not required. That's not important. That whatever you're doing, if you're lending money, if you're lending assets, whatever, they keep in mind that there should be a transaction, there should be profit, that's it. And purpose of financing, we can say in Islamic finance, it's all about ethical investments and ethical, means of transactions. Whereas in conventional finance, they only care about profit maximization. They only care about how much profit they're earning, and all about the profits. It's simple as that. So, if you look at the regulatory framework regarding governance and compliance, so we know that Islamic finance operate under a unique regulatory framework, which means that there are rules and regulations made specifically for financing in Islam. And we follow Sharia boards. There are Sharia compliances that should align products with both national regulations and Sharia guidelines, which means that there are some specific rules and regulations that match up with the national regulations that a country has, and also some Sharia guidelines that we have due to Islamic framework, or you can say that like that. And these all harmonization is essentially for cross-border transactions, which is why it's necessary to have both the aspect in mind so that we can transact we can have transactions internationally as well and in our own country as well. Time value and commodities. If we talk about time value and commodities, so in Islamic finance, money is not treated as a commodity. Instead, Islamic principles recognize the time and place of that commodities, which means, for instance, a bottle of water that cost 60 rupees in a city but rupees 100 on the motorway, or you can see a mall, or reflecting location based value differences. So but and in a salam contract, if we talk about salam contracts, so payment is made upfront and delivery is deferred, which means delivery is deferred means that you are paying for the product right now, but it's going to be delivered in the future. So here the price might be lower than the market rate to reflect the deferred contracts, or you can deferred delivery. So Islamic finance usually allows such variations based on genuine supply demand dynamics, but it also prohibits earning from loans or money without risk. Let's talk about some factors of production in Islamic finances. Some factors of productions, we can say that basically Islamic finance views factors of productions differently from conventional finance. So we have capital that must be consumed or altered during production and cannot earn interest. That's it. So means must involve consumption or transformation, and no interest means no riba. Other than that, if we talk about labor, so these are entitled to wages. Like if a worker is working at your place and you're giving them their salary, so that's entitled to wages. If we talk about land, so land are also natural resources without prior of in production, which means that natural resources used without prior production processes. And then entrepreneurship, it combines all the factors and earns you profit with obviously risk. So from an Islamic perspective, ownership brings profit and services brings wages, but all profits must involve some form of risk. So in combine, I can combine this in this one sentence. Let's move on. So future trends. If you look at the future trends of Islamic financing, so 45% projected growth of Islamic finance, which means that Islamic finance is expected to grow significantly within the coming years and gaining market share globally as awareness increases. It depends of how much people are aware about Islamic finances. So there is a chance of growth of 45%. If we talk about integration of fintech, so we know that technology is increasing day by day, and there are emerging technologies that can influence the operational frameworks of Islamic finance, and obviously that can give a push to the growth and accessibility of these kind of concepts. Worldwide market expansion, we know that the market is expanding exceptionally nowadays, and efforts are being made to penetrate non-Islamic markets, and it's increasing the reach of Islamic finance products. So we hope that there's a 30% now increase, going to be an increase in worldwide markets for Islamic finance, and 25% of integration of fintech. So if we're going to talk about some conclusions here, so we can say that the Islamic finance basically offers a unique and ethical alternative to conventional banking, and empathizing risk sharing or fairness and community well-being. Its rapid growth actually reflects a shift towards sustainable and inclusive financial systems. So thank you for listening, and we'll see you next week, hopefully, with another topic in Islamic finance. Thank you so much, everyone. Have a great day.